Welcome back to the deep dive. Today, we are taking a really fascinating look at something often maybe a bit overlooked, the silver market. And specifically, we're examining why quite a few experts believe it is, well, poised for a pretty significant multi-year repricing event. Our analysis is really anchored in some recent structural research, and we're leveraging insights from a senior specialist over at Sprott Asset Management. So, our mission today for you listening is pretty straightforward. We want to move beyond the sort of day-to-day noise and really understand the deep structural forces that suggest silver's recent rally is, as they put it, only the beginning. We really need to follow the historical roadmap here. There's a spectacular blueprint from another metal, actually, to grasp the potential scale of this move. And we need to quantify the magnitude of the, frankly, colossal supply deficit that's built up over half a decade now.
Yeah.
And perhaps most importantly, connect silver's current scarcity to its, well, non-negotiable role in accelerating global technology and green energy infrastructure. It's a big picture.
Yeah, and that framework is absolutely critical because what we're discussing isn't some abstract future projection. It's actually happening right now as we speak. Silver has already made a huge, really decisive move. It recently hit a new 14-year high, trading well above the $44 per ounce mark. What's truly essential for you to internalize is that this specific price action, it isn't just a fleeting bounce or some speculative surge. It feels like the market is finally starting to recognize these profound systemic shifts in global supply and, crucially, industrial demand. We might just be witnessing the very first ripples of a potential tsunami.
Okay, so let's nail down the current investment landscape first, because when a market is hitting levels you haven't seen in 14 years, the conversation inevitably gets a bit fixated on the past peak, right? For many investors, especially those focused on metals, the whole conversation about silver's upward potential seems squarely focused on hitting that huge psychological and historical ceiling, the all-time high of $50 per ounce. It feels like the finish line, doesn't it? It absolutely does. And you're right, $50 acts as this massive psychological resistance level, just
Yes.
given its history. It's burned into memory. However, the core thesis emerging from the specialist analysis we're looking at today suggests that focusing only on $50 means you're dramatically undershooting the true opportunity here. Shri Kargutkar, who is the senior portfolio manager and silver specialist at Sprott, he's quite explicit in stating that the current rally, even after hitting $44, is still very much in its early stages.
Okay, early stages. That's a statement that requires some serious conviction, especially when you're already trading near levels not seen for well over a decade. So if we're meant to look past that $50 psychological barrier, what precisely is maybe the quantitative forecast or the calculated potential according to their deep fundamental analysis? Well, the analysis doesn't just dismiss $50. It sort of uses it as a waypoint, if you will. It suggests that based on the current structural pressures and maybe some technical formations, there is still over $6 of, let's say, readily available upward potential left in this price movement. And that's even before considering any kind of exponential acceleration phase, which often happens later. So if we just take the current price range and add that foundational potential, it implies a pretty significant move beyond the $50 all-time high.
Right. So if the sort of common investor conversation stops at $50, the structural analysis is suggesting that maybe $56, perhaps even higher, is where the market could settle its next plateau. But that requires us moving past a lot of skepticism, I think. If we're being told that a historic rally is merely the setup, we need some compelling evidence that this time truly is different. We need a parallel, a market that has already demonstrated this exact kind of trajectory.
That's the critical pivot point in the argument, exactly.
Yeah.
We have to look for a commodity that experienced these kinds of multi-year foundational deficits, yet saw its price lag for years, only to absolutely explode when institutional investors finally kind of woke up and understood the scarcity.
Yeah.
And the best analog the experts can point to, the one that really fits the bill, is the market behavior of palladium. Palladium provides, a pretty much perfect roadmap. It's a stark lesson in how markets can ignore fundamental scarcity for extended periods, and then how vicious the price action can become when that scarcity finally hits a critical mass.
Okay, before we dive into the timeline, maybe just for the listener who might not immediately connect the dots, what is palladium primarily used for? Why did its demand become so structural, so locked in?
That's an excellent question. Palladium's core use, and really the driver of its recent explosive demand, is in catalytic converters. Specifically for gasoline-powered vehicles, environmental regulations globally demanded cleaner emissions, making palladium essentially indispensable for neutralizing harmful exhaust gases. This created this sort of non-negotiable industrial demand that couldn't easily be substituted or engineered away quickly. It was structural.
Okay, so structural, non-discretionary industrial demand tied to global regulation. Got it. Now let's look at the numbers and that timeline of its surge. It sounds dramatic.
It was. We're looking at a period of about 6 years where things really went wild. Early in 2016, palladium was trading around, say, $500 per ounce. Pretty modest. Now, the crucial context is the metal had already been in a fundamental supply deficit for years before that, yet the price reflected none of that foundational weakness. It was just stuck. Then, seemingly out of nowhere, the market woke up. By May of 2021, prices had already surpassed $3,000 per ounce, a huge jump, and the run peaked really dramatically in March of 2022, reaching an astonishing high of $3,425 per ounce. Just incredible.
That magnitude is,
Gosh.
no, it's hard to absorb. We are talking about the price of palladium surging nearly 600% in those 6 years, specifically from 2016 to 2022. It's an exponential explosion driven by that scarcity finally colliding head-on with locked-in demand. And this 600% surge is precisely what the Sprott specialist uses to put silver into perspective. They point out that silver's 52% increase year to date, which sounds impressive in isolation, right? Well, it appears incredibly modest, almost negligible, really, when you lay it against the backdrop of that historical palladium surge. It suggests that if silver is truly following this blueprint, its current climb is maybe just the quiet opening minutes of the movie.
That analogy really holds up because the underlying pathology, the underlying reason, is identical. The catalyst for the palladium boom was a supply and demand imbalance, an imbalance that actually started brewing much earlier, maybe around 2012, but which the market completely failed to price in until 2016. It just ignored the fundamentals. If we sort of dissect that crucial lag period, say, 2012 to 2016, palladium saw consecutive years of growing industrial demand tied to those stricter environmental regulations we mentioned, coupled with severely stagnant supply. The supply side just couldn't react quickly enough to meet the new demand from automakers. But investors, they seemed distracted maybe by other metals, other macro events, whatever it was, and the price just remained depressed, hovering around $500.
Huh. So if I were an investor back then, focused purely on palladium fundamentals during, say, 2013 or 2014, I would have seen this clear deficit on the balance sheet, but zero price action reflecting it. That must have felt incredibly frustrating, maybe even misleading.
Precisely. And that's often the nature of these big commodity cycles, driven by fundamental, slow-moving shifts. The price didn't react for years because the market, collectively, hadn't woken up to the severity of the industrial consumption. It wasn't until around 2016 that, as the analyst described it, quote, investors suddenly had the light bulb turn on. They realized that the metal was critically needed and the above-ground stocks were functionally running out. Panic set in.
What's fascinating here, then, is that the palladium example doesn't just provide a possible, upside target or a percentage gain to think about. It actually provides a sort of behavioral defense for the current silver thesis. It suggests that the slow, almost hesitant price reaction we're seeing in silver right now, despite this universally acknowledged 5-year deficit, is entirely consistent with how these deep structural deficits often materialize. Price reaction lags the structural reality, sometimes by years.
Exactly. The market is often waiting for that panic moment, the moment that physical availability becomes a visible crisis. But the foundation for that crisis has been laid quietly over years. Which brings us directly to the core structural problem for silver, the deficit itself. We need to talk numbers.
Right. If the palladium roadmap is believable, if that's our parallel, then we need to quantify the structural reality for silver. This is where we shift focus entirely to the supply side dynamics. Now, the analyst did note that measuring existing above ground stocks of silver is notoriously difficult. It's not like you can just count barrels. It's a pretty opaque market, isn't it? So how are we actually quantifying this ongoing scarcity?
Yeah, it's tricky. You can't just look up a single reliable number for all the silver bars sitting in vaults worldwide. So we quantify it by looking at the persistent rate of consumption versus the rate of production year after year. And the duration of this imbalance is the really crucial piece of evidence here. This deficit hasn't been a one-off annual event like a bad harvest. It has lasted for 5 consecutive years. 5 years straight. That's half a decade of the world consuming more physical silver than it is mining and recycling combined. And it's this very accumulation, this compounding effect of 5 years of chronic shortfall that is finally depleting inventories, visible and invisible, to the point where prices are being forced to react now. We can actually put a pretty staggering number on this accumulated shortage. The total silver supply deficit built up over just the last 5 years is estimated to be approximately 800 million ounces. 800 million ounces. Let's just pause on that number for a second. That is a structural hole in the global inventory. It's not something that can be filled by simply opening a few new small mines next year. It's enormous.
Wow. 800 million ounces. That's nearly a billion ounces of required supply that has effectively been filled by drawing down existing reserves somewhere, right? To give you listening some perspective, what percentage of global annual production does that 800 million ounces represent? And maybe how does it compare to the visible, publicly known inventories, like the ones held on exchanges like COMEX?
Yeah, that 800 million ounces is absolutely massive. It represents significantly more than an entire year's worth of global silver mining output. Global mine production generally hovers somewhere below the 850 million ounce mark annually, give or take. So we're talking more than a full year's production gone missing over 5 years. And if you look at the visible inventories, the ones we can see on major exchanges like the COMEX or the LBMA in London, that accumulated deficit absolutely dwarfs those holdings. It means the world is increasingly relying on smaller and smaller pools of available tradable physical metal to manage this massive surging industrial demand. The buffers are getting thin.
And the pressure isn't letting up, is it? What's the projected deficit looking like for the current year? Is it confirming that this structural drain is continuing?
Yes, it is. The projected supply deficit for this current year is expected to be around 187 million ounces, still a very large number. So that means even if the price continues to rise, the fundamental imbalance remains firmly in place, ensuring that those reserves, wherever they are, continue to be drawn down at a pretty furious pace.
Okay, this persistent deficit raises a huge question about the longevity of this dynamic. Why isn't mining supply reacting more strongly to higher prices? Why can't the industry just ramp up production and close this gap? We see it in other commodities sometimes.
This is where understanding the metallurgy of silver is absolutely vital. It's different. Unlike, say, gold or copper, which are often mined from primary deposits where they are the main target,
Yeah.
the vast majority of silver, often estimated at around 70%, maybe even more, is produced as a byproduct. It comes out of the ground when miners are actually targeting other base metals like lead, zinc, and copper, or sometimes even gold. Silver is just along for the ride, effectively.
Ah, okay. A byproduct.
Think about the implications of that fact. It means the supply of silver is largely inelastic to its own price. Its production rate is primarily dictated by the global demand and pricing of lead or zinc or copper, not necessarily the rising price of silver itself. So if copper miners decide to ramp up production because copper prices are great, then silver supply might rise as a secondary benefit. We get more silver accidentally, so to speak. But if silver prices soar on their own, miners can't just suddenly decide to open a pure silver mine overnight. The timeline for permitting, exploration, development, and actually building new primary silver mines is incredibly long and complex. It takes many, many years, sometimes a decade or more.
That's a critical detail, isn't it? It means that while demand for silver can go exponential, driven by these huge technology trends we'll get into, the supply response remains slow, linear, almost sluggish, because it's tethered to the economics of entirely different metals.
Precisely. The analyst is very clear on this point. They do not foresee this market dynamic changing in the near future because the fundamental issue is structural. It's baked into how we get silver out of the ground. Mining supply simply cannot keep up with the rate of exponential demand growth we're seeing, and this persistent shortage fundamentally changes silver's identity in the global economy. It transitions from being, just a simple precious metal used for jewelry or hedging inflation into something far more necessary, far more vital.
It's effectively transformed from just an investment instrument into a critical industrial asset. That seems to be the core realization emphasized in the source material. It's an indispensable input that underpins massive, non-discretionary macro trends, which is precisely why the lack of 800 million ounces of supply over 5 years is such a profound problem globally. Okay, so to truly believe in this early stages thesis, we absolutely need to understand the demand side in more detail. We need to see why this demand is potentially irreversible, maybe even exponential. Let's start with probably the most visible area of surging consumption right now, the global energy transition. Focus area number one is, naturally, solar energy. Silver is a critical component. It's used in a conductive paste, basically, in photovoltaic cells, which are the fundamental building blocks of solar panels. As nations globally mandate shifts toward renewables, and as solar becomes economically competitive, the demand for solar panels just grows relentlessly.
And this isn't just, theoretical adoption on paper. It's a massive, tangible economic shift happening on the ground. Solar power has become highly competitive, often cheaper than traditional heavy fuels in many parts of the world, which accelerates its deployment. Now, while the expert does note a technical limitation, that it's still difficult to use solar energy as a true baseload power source, meaning available 24/7 reliably without storage, it's universally accepted now as a vital, rapidly growing supplement to the overall energy mix. And this reality pushes its adoption rate higher and faster than perhaps many anticipated even just a few years ago.
And we're seeing that adoption being disproportionately driven by emerging markets, aren't we? Places that need energy independence and sustainable growth pathways.
Absolutely. The analysts specifically highlighted that a large portion of the surging green energy demand originates from nations that are aggressively transitioning their infrastructure away from fossil fuels. India, specifically, was cited as becoming a real market leader in this area. They aren't just planning new capacity in megawatts anymore. They're aiming for gigawatts of new clean energy capacity to power their accelerating economy. This places enormous, continuous, and pretty much non-negotiable demand pressure directly on the silver supply chain. Every panel needs silver.
Okay, so solar is huge and growing fast. But while the headlines are often dominated by solar power, the analysis also stressed something important, that the electronics industry, the sort of traditional user of silver, is actually still the largest single sector of consumption overall. And apparently its demand profile has also undergone a massive fundamental shift recently. What's happening there?
Correct. Electronics, broadly defined, remain the top consumer category for silver. But we have to look beyond just, more smartphones or laptops. We need to examine the core capital expenditure strategies of the world's largest companies. The analysts performed this really fascinating piece of due diligence, looking at the CapEx, or capital expenditure, plans among major corporations, particularly those driving the S&P 500 and the NASDAQ indices. And they framed this change as nothing short of a dramatic paradigm shift. Here's the comparison. 5 to 10 years ago, most corporate capital expenditures were maybe leaning toward technology investments. There was a mix, upgrading factories, buying physical assets, traditional R&D, marketing, and some tech spending, a blend. But now, in the current paradigm, technology makes up nearly all significant corporate capital expenditure. It dominates the budgets.
Wow. Let's unpack what that means in practical terms. Why is essentially every dollar of corporate growth spending now effectively a dollar spent on technology? What's driving that total concentration?
Well, frankly, it's the cost of staying relevant, maybe even the cost of survival in the modern economy. We're talking about the massive, ongoing build-out of cloud computing infrastructure globally. Think about the arms race in AI processing power, which requires colossal data centers filled with specialized hardware. Consider the complete digital transformation happening in literally every sector, from logistics and shipping to finance and healthcare. All of these core growth engines, the things that keep major companies profitable and competitive, they all rely heavily on semiconductors, high-efficiency connectors, complex circuits, advanced sensors, all of which require silver due to its connectivity and reliability.
So this isn't discretionary spending anymore, the kind that gets cut first in an economic downturn. This is now the core cost of simply operating and attempting to grow a modern multinational business. If these companies stop spending this tech capex, they essentially stop existing as a competitive entity in their market. Is that the idea?
Exactly. That's the crucial takeaway. This dramatic concentration of tech capex means that the demand for silver is not just relentless. It's now entirely coupled with the global growth rate of the digital economy itself. And because, as we established, mine supply is largely linear and slow to react, remembering that byproduct issue, while tech demand appears exponential, well, the conclusion seems inescapable. The structural imbalance, that deficit, is pretty much guaranteed to continue, likely deepening that 800 million ounce hole even further over time.
Okay. And that combination alone, inelastic supply, exponential structural demand from solar and tech, would probably be enough to make a powerful case for a structural price increase. But the expert layered on one final piece of complexity that acts as kind of an accelerant or a multiplier, which is the impact of global fragmentation, right? This issue of global economic fragmentation. It introduces a sort of geopolitical multiplier effect onto the scarcity problem we've been discussing. It suggests that even if, hypothetically, we had enough silver somewhere on the planet, the actual ability for companies or countries to access it easily and reliably is rapidly diminishing. Is that the gist?
That's exactly the gist. This moves us firmly into a macro-geopolitical model shift. For decades, the dominant global operating model was the just-in-time, or JIT, economy. That was a system optimized purely for efficiency. Global supply chains were designed to be easily interchangeable, highly transportable, and access to resources from anywhere was generally assumed. Inventory, holding stock, was seen as an expensive liability, something to minimize. But the current geopolitical environment, marked by trade tensions, regional conflicts, geopolitical risks, and let's not forget the shock of the recent pandemics, has forced a rapid and likely permanent shift away from pure JIT. The new model, which is gaining traction very rapidly now, is moving decisively toward a just-in-case JIC economy. This new model prioritizes resiliency, security of supply, and redundancy. It places massive emphasis on the need for domestic inventories and strategic stockpiles of critical materials.
Okay, so JIC versus JIT. If I'm a government looking at national security, or maybe a major manufacturer looking at production continuity, I can no longer just rely on that cargo ship arriving precisely when I need it from halfway across the world. I feel I must have my own cache of critical metals like silver sitting in a domestic warehouse ready to go just in case something disrupts the global flow. What's the tangible implication of this JIC shift on the available tradable supply of silver out there?
The implication is profound, actually, because it actively removes physical metals from the open fluid market. It takes it off the table. Even if overall global silver production were to increase slightly next year, this fragmentation, this JIC mindset, creates potentially dangerous imbalances in the global supply chain because access becomes localized and prioritized by national interest or corporate strategy. This growing priority for nations and large companies to maintain sufficient domestic stocks, whether they are formally designated national strategic reserves or just large corporate buffer inventories, it physically draws silver out of the internationally available, visible market. Think about the metal held in the COMEX or LME warehouses, the stuff traders watch. JIC hoarding locks that metal down into longer-term strategic storage, making it unavailable for immediate industrial use or trading.
Huh. So this essentially creates a kind of artificial scarcity, maybe a supply squeeze, right on top of the already massive industrial deficit we talked about. You get a sort of double whammy effect. You've got soaring non-negotiable tech and solar demand pulling metal out for consumption, and simultaneously geopolitics is encouraging strategic hoarding, pulling more metal out just for storage. That's a perfect way to put it. A double whammy. This shift tightens global availability dramatically. And the existence of these strong geopolitical drivers means that countries and companies are likely willing to pay a significant premium to establish and maintain those JIC reserves. It's seen as a cost of security. This strategic hoarding element layers a powerful, somewhat non-market-driven demand factor right on top of the already massive industrial deficit. It further contributes to sustained upward pressure on the price. It really suggests that this potential move past $50 is being backed not just by things like solar panels and AI chips, but increasingly by national security strategy and supply chain resilience concerns. It's a much broader base of support. Hashtag outro. Okay, let's try and synthesize the enormous amount of structural pressure we've just unpacked here. It's quite a picture. We started by noting that the current silver rally, the one hitting 14-year highs, is viewed by specialists not as the end, but merely as the opening act. Their fundamental analysis points to, conservatively, maybe over $6 of readily available upside potential still remaining, even from these elevated levels.
Right. We then used the Palladium blueprint as a crucial historical analog. That showed us how a deep structural deficit was completely ignored by the market for about 4 years, from 2012 to 2016. Leading to a delayed but absolutely explosive 600% price surge once that scarcity finally became undeniable and hit the headlines. And silver right now is sitting on an accumulated 5-year deficit totaling a staggering 800 million ounces, with its supply fundamentally inelastic, guaranteed by the geological fact that the metal is overwhelmingly a byproduct of other mining operations. Supply can't just catch up easily.
And this massive structural shortfall is facing relentless and largely non-discretionary demand pressures. That demand is being driven forcefully by the global energy transition, with emerging markets like India leading a solar revolution. And it's compounded by that complete paradigm shift in corporate spending, where nearly all major capital expenditure now relies directly on the silver-consuming technology sector. Everything is becoming tech. And then finally, geopolitical fragmentation is acting as an accelerant to this scarcity, pushing the world into a just-in-case economy that actively encourages strategic hoarding and removes even more physical silver from the readily tradable market.
Yeah, the confluence of these forces, this foundational, almost irreversible industrial demand meeting this new wave of strategic geopolitical hoarding, it really suggests that the market realization of silver's true scarcity is, well, probably inevitable. And it seems to be pushing the metal into an entirely new phase of fundamental value discovery. This doesn't feel like a fleeting spike driven by short-term retail speculation. It feels much more like a profound repricing event, a repricing driven by 5 years of accumulated consumption that the market is perhaps only just beginning to truly pay for now.
And that leads us perfectly to our final provocative thought for you, the listener, to mull over. Given that this deficit appears so thoroughly structural, driven by huge macro shifts like the global energy transition and overwhelming tech dominance, and knowing how painfully slow mine supply is to react, How long can that supply realistically lag behind this explosive, non-discretionary demand before the price is forced to react even more dramatically than the already stunning 600% precedent set by palladium? That's something to monitor very closely, I think, as this critical industrial asset continues its ascent.